In today's episode of the Daily Brief, I'll talk about two interesting stories. I'll first talk about trying to understand the tariffs, and finally, I talk about fast food, faster business. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Wednesday, 20th August. Coming to the first story, we sort of overdosed on the Trump stories towards the beginning of the year. And ever since, we've been trying really hard to ignore the noise coming out of the United States. But here we go again. Practically out of nowhere, India's biggest trading partner has slapped us with a 50% tariff. That's a 25% base tariff with an additional 25% slapped on, supposedly because we buy Russian oil. And that punishment is something that we at Markets at least don't get the logic of. We covered that one on a recent Who Said What though, so we won't repeat ourselves here. Now the first 25% of those are already in force. Another 25% will kick in from August 27th. Or they may not. Who knows? Those tariffs, if they stick around, could practically close the world's biggest consumer market to our exports. Enough has been written about what that means, so we won't repeat things. We'll leave you with a couple of good charts from Bloomberg. Here are our biggest exports to the US. And if they're tariffed, here's what American importers will have to pay if they want to buy our goods. From what we can tell, there'll be some pockets of our economy, from shrimp exporters to carpet weavers, who will see a short period of extreme pain. But to tell you the truth, this is a terribly confusing situation. It's too extreme and too sudden for anyone to accurately tell you what might happen, and we aren't quite sure of how to even think of them. Thankfully, though, we're starting to see rigorous research around what these tariffs are doing. Today, we're going to look at two such pieces. A comprehensive bulletin by the Bank for International Settlements, as well as a paper by Ignatenko, Lashkaripur, and others. It corroborates a lot of what we have said for a while. The picture they paint is more complex than most people realize. So how exactly do tariffs even mess with an economy? Obviously, they make imports more expensive. But that's just the beginning. It's just the first stone cast into a calm pond. And once that's done, the waves ripple outward. For one, they create what economists call the direct trade impact. When a country slaps tariffs on its imports, it chokes supply. People in that country see prices of imported goods shoot up, almost as if there was a sudden shortage of those things. That guts their real wages. That is, although their paycheck might stay the same, it buys fewer things. Now, how precisely this plays out can vary, depending on the margins businesses had and how much more people are willing to pay. But this is bad timing. See, inflation is often a matter of what people believe. If people believe prices will go up further, they hoard supplies, sending prices up. Meanwhile, businesses find people more tolerant of higher rates. As people lose sight of what prices should be, as these expectations become unanchored, this vicious cycle becomes increasingly hard to fight. Many Americans never even recovered from the post-pandemic surge in inflation. Their expectations weren't anchored to begin with, and when you add staggering tariffs like the 54% on Chinese goods, that could derail those expectations severely. In the aggregate, the research points to one thing. The US, despite being the one imposing the tariffs, suffers the most. Although America's tariff revenues quadrupled in July, that came at a cost. The country is modeled to take a growth hit of approximately 1% of GDP growth. But things get more complicated from here. Once this plays out, three indirect channels take over. First, your supply chains break. Imagine you're a car parts manufacturer and the steel you need suddenly costs 25% more. Switching suppliers takes time, and in the meanwhile, you might reduce production, but that creates bottlenecks for everyone that depends on you. These problems cascade through entire industries, creating shortages and price spikes. Second, the trade heading your way starts going elsewhere. Now, this is already happening. Chinese exports to Europe and Southeast Asia have surged, while exports to the US have collapsed. And this flood of diverted goods can depress prices in their new markets, hurting their manufacturers. Some ASEAN countries are already seeing their manufacturing struggle in the face of Chinese goods. There's uncertainty, which is the one thing businesses hate more than high costs. When trade policies keep changing, when deals get made and unmade, companies freeze, unable to judge what risks are worth taking. They stop investing, delay hiring, and cancel expansion plans. And this can damage growth as much as the tariffs themselves. So this tariff story looks very different depending on where you live. For advanced economies like those in Europe or Japan, things are probably more muted. They have diversified trading relationships, sophisticated markets, and the policy tools to respond. Coincidentally, these are also the very markets that have struck deals for lower tariffs. But there's a twist. Trump's tariffs could actually be deflationary for these countries. Their economies will have to accommodate the produce of their own manufacturers, who will see lower export demand as well as goods from other countries that are looking for a rich market. All of this could push prices even lower. But emerging markets face a much more complex picture. On one hand, some will definitely look for opportunities in the debris of 50+% tariffs on countries like India and China, but they'll also run massive risks. So far, in a weird way, the trade tensions have actually been good for emerging markets. They pushed down the value of the dollar against other currencies. And that was excellent news for many businesses in emerging markets who had borrowed in dollars. As long as the dollar's value stayed in check, this debt load was comfortable. But this isn't a patch of good luck that you can trust. With so much chaos, you could easily see an abrupt reversal, pushing up the dollar's value and putting massive pressure on those same borrowers. If the tensions push an emerging market into a crisis, they could well be stranded. As the research shows, emerging markets often have less fiscal and monetary firepower to respond to shocks. If growth slows, they can't cut interest rates or boost government spending the way advanced economies can. Two countries, though, deserve special mention: Canada and Mexico. These two countries face what economists call stagflationary effects that might be second in scale only to the United States. They were integrated deeply with the US economy for decades. Even as the tariffs have hit, diversifying away from American markets hasn't been easy. Now, unlike a conventional war which often has a victor, nobody wins a trade war. And that's what the research expects to happen this time around as well. Even though some countries have reached bilateral trade deals, average US tariffs are likely to settle at levels unprecedented in the modern era. At the end of 2024, America's average tariff rate was at 2.4%. The best deal it has now offered to the United Kingdom puts these at 10%. The rate on everyone else is even higher. At these levels, you should expect a meaningful drag on the global economy. And if things escalate any further, some economies could be thrown into a full-blown recession. We're already seeing early warning signs. Recent US data indicates that people are spending less even as costs rise, and the economy is struggling to create jobs. Outside the US, meanwhile, consumer confidence has fallen in economies all around the world. Corporate earnings, too, are feeling the pinch. See, this would have been a bad sign even in the best of times. But even before this latest round of tariff escalation, global growth was already slowing. But these latest tariffs have added an extra layer of disruption to an already fragile economic environment. But we haven't seen the real damage yet. So far, the global economy has been remarkably resilient. As soon as the announcements were made, American companies front-loaded their purchases, rushing to stock up their inventories before tariffs hit. And this resulted in a temporary boost to trade, masking the weakness beneath. And that bump in trade may even have distorted near-term GDP figures. But that exercise is already over. A lot of the resilience we're seeing was on borrowed time, and that time might be running out. In its place will come a persistent uncertainty tax, where businesses stop making long-term decisions. In the past, the research suggests this level of uncertainty shifted growth distributions downward by up to 2 percentage points. For many countries, that's the difference between healthy growth and stagnation. Through all this chaos so far, financial markets have played the role of an economic shock absorber. Financial conditions have remained remarkably accommodative throughout this trade tension. After the rout that followed Trump's infamous liberalization day on April 2nd, markets rebounded. The panic was short-lived. As trade tensions weakened the dollar, even more money flowed into American markets. Now, this wasn't dumb luck. All over the world, central banks were willing to keep financial conditions loose in face of all the uncertainty. That created a large spout of money that could flow anywhere. Many companies too reacted smartly to the chaos. Anticipating tariff impacts, many firms rushed to secure credit lines in late 2024, and this gave them a war chest of liquidity that has helped them weather the initial storm. But financial markets can be a double-edged sword. For one, those liquidity buffers aren't infinite. According to the research, firms in tradable sectors, that is, those that sell their goods or services across borders, could struggle to sustain operations for more than a quarter without new cash flows coming in. In many markets, firms in sectors that are exposed to trade are already stretched thin. As balance sheets come under the risk of getting stretched, valuations remain high. A correction now could create serious problems, especially if banks decide to pull back on lending at the same time. Those stresses, in a worst-case scenario, could ripple through the system. An acute shortage of money at one node of a supply chain could create cascading problems for anyone that does business with it. The absolute worst case, however, will arrive if the world loses confidence in the dollar's role as a global safe haven. That would create cracks in the entire edifice of dollar based global finance, and we won't even pretend to know what might happen then. So, where does this leave us? All the research we've looked at paints a picture of a global economy under pressure from many directions. India's 50% tariffs aren't coming in isolation. They're part of a much larger, tangled web of trade disruptions, supply chain breakdowns, and financial vulnerabilities. The universe we're heading into could be one where global employment contracts by 0.58%, hitting workers everywhere. In practical terms, that's something like 21 million people that might soon be out of a job. So far, circumstances have ensured that the blow is limited. Companies have been smart in planning their way through these tariffs, both in managing their inventories and in ensuring enough liquidity. Financial markets have ridden through the chaos stoically. Phenomena like front loading and dollar weakness have given them some breathing space. But that resilience could easily flip. The resilience we've seen so far has been on borrowed time. The harsh truth is that trade wars don't create winners. They only shift losses around. Unless policy pivots towards stability rather than escalation, the global economy may soon discover just how difficult things can get. Now, coming to the second story. Remember that late night Domino's order when nothing else was open? Or that McDonald's breakfast you had after partying all night long? Or the Burger King meal that somehow tasted better than you remembered? These brands are so embedded in our daily lives that we barely think about the companies running them. But maybe we should. The businesses behind these familiar brands run extremely tight operations to ensure that every next meal you order from them feels just as delightful as the last. In their first quarter results, we found a fun story about the economics and logistics of how these quick service restaurant businesses fulfill the cravings of millions of Indians every day. We'll be specifically looking into the results of three such Indian companies: Jubilant FoodWorks, which runs Domino's, Westlife Foodworld, which runs McDonald's, and Restaurant Brands Asia or RBA, which runs Burger King and Tim Hortons. So how do QSRs even work? On the surface, QSRs just seem to make food fast, serve customers quickly, and collect money. But we know never to judge a book by its cover. Underlying this simple operation is a unique business model called the master franchisee model and a mastery of supply chains and technology. So in the master franchisee model, QSRs operate as a master franchisee of the big brands you love. To use the famous names of brands like Domino's and McDonald's, these QSRs pay those brands an initial fee and 5 to 6% of everything they make. In exchange, they get the exclusive right or a master franchise to operate these brands in India, along with all the recipes and global marketing power that comes with them. Except for changing the logo or brand name, these QSRs have nearly full authority to grow these brand names in India however they choose, be it changing menus altogether to suit Indian tastes or opening new outlets anywhere. But this great power doesn't come without risks. If you win, the upside is yours. If you lose, though, you will have to bear the losses. And one of the biggest risks is that of location. Imagine you're a QSR that's trying to expand your brand to new tier 2 towns in India. Now, these locations are untested grounds. You don't know whether your outlet will succeed here or not. If it runs into losses, you want to be able to exit the location as quickly as possible and open somewhere else. In order to do that, you might want to rent your property instead of buying it straight up. Now, property rent is a major cost item in the finances of QSRs and can be the difference between success and failure. Pick the right location and you're printing money. But pick wrong and you're stuck paying rent on a dud for months. Here's RBA outlining how important rent optimization is for them.
But the other, journey will continue, which is about reducing rents, and we continue to renegotiate rents of all our restaurants over there. So that work will continue, and we will continue to try to optimize that as well. So the portfolio optimization, I think we are in the last phase of it, and then we will continue the rent optimization as we go forward.
So the promise of Indian QSRs lies in satisfying their customers as quickly as possible, and robust supply chains are a key part of ensuring that. Every Maharaja Mac has to taste the same, whether you're in Delhi or in Chennai, and that requires serious logistics. For example, the vendor you source your expensive olive oil from has to be suitable for your menu, and you should have enough cold storage facilities to ensure your vegetables are preserved well. And all this must be done profitably. It isn't always easy to do both, especially if both goals have tensions between each other. For instance, when tomato prices double during monsoons, these companies can't just switch to something cheaper or even pass on the higher prices to consumers like us. They have to absorb the cost or risk disappointing customers. So, how do QSRs resolve this? They try to use one stone to knock down two birds. Lower costs and have every item taste similar everywhere. Now, the QSRs get a part of the cooking done beforehand by a central hub called a commissary kitchen. Here, the raw materials like cheese and tomato are converted into more complex ingredients for the outlets. The outlets mostly have to spend time assembling and putting the pizza into the oven or deep frying the chicken. And this makes their cooking not just standardized across India, but also more efficient. In the last decade, technology has helped streamline these supply chains a lot more. For instance, QSRs have automated large chunks of how customers order food now. Take McDonald's, which has large self-serving kiosks at many Indian outlets, or Domino's, which has its own mobile app and delivery tracking. But this is just what you, the customer, get to see. In the back end, QSRs rely on analytics to track not just where and what, but also when and how often customers order and which customers need discounts. They also use data extensively to ensure their inventories never have shortages or excess supply and plug other gaps in the supply chain. Rent and supply chain investments aren't the only heavy costs. Restaurants require a lot of manpower, which means spending a lot on salaries. Additionally, they have to face a lot of competition. The barriers to opening a restaurant are fairly low. As a result, profits are really hard to come by in the restaurant business. Even if a restaurant is profitable, the profits aren't huge. The net margin of Jubilant, for instance, was 5.2% this quarter, while for Westlife, it barely exists at 0.2%. So, QSR businesses focus more on what they can control, their day-to-day operations, and that's usually represented by gross margins and EBITDA. But as we shall see, those metrics were a little out of control this quarter as well. The Q1 FY26 results of these companies show how even similar business models can produce very different outcomes. By far the largest of the three businesses, Jubilant FoodWorks revenue grew a whopping 18% to rupees 1,701.6 crore. People are ordering more as volumes jumped over 17% from last year. Every day this year, the average sales across all their outlets was rupees 85,396. They also opened 71 net new stores during the quarter. What's really interesting for Jubilant is that most of their sales don't come from in-store dining, but delivery, a whopping 73% of sales. Westlife grew revenue about 7% to rupees 657 crore by taking a more measured approach to expansion. They added 9 new McDonald's restaurants, but also closed 3 that weren't performing well. Their dine-in and takeaway business grew 8% and now makes up about 60% of sales. The other 40% is food delivery, much lower than Jubilant though. RBA's Indian operations are growing healthily with revenue up 13% to rupees 552.3 crore. On average, each Burger King store generates a whopping rupees 1,20,000 per day, higher than most QSR chains, and they added 6 net new Burger King stores. However, this expansion is proving very costly to them. In contrast to Jubilant and Westlife, they've been recording net losses for the last few years, losing rupees 42 crore this quarter alone. The reason boils down to stiff competition. To gain market share in such a crowded market, Burger King India is selling their low-ticket, value-conscious meals a lot more than their premium items. And this shows up in sales being higher, but margins being far tighter, even negative. The slow growth of RBA's more recently started Indonesian business has also worsened their profitability. Revenue actually fell 6.9% from the last year. The average daily sales of Burger King Indonesia has been improving for 9 straight months, but at a snail's pace.
But if you look at our sales in the last 9 months, 8 out of those 9 months, we have driven higher ADSs from the previous years. If you look at from November to July 2024, November to July 2025, we have grown 5% year over year in ADS. So we continue to grow that top line. We have done it initially when we spoke to you. There was only one chicken offering. There was the classic layer. We had bought in a spicy layer in there. And now Sandeep will tell you what we have done further, because we first fixed the menu. We had challenges when we went into the business about the quality of products. We did the surveys, we fixed all those products, but Then you start inviting people back in through, bringing in new products. And cheese and spice is the way the country runs. So we will share with you what Sandeep will share with you what we have done in the last promotion, which has driven high volumes of people coming back into our business. So a million more in areas that we have driven, and we have bought that home. And we are really literally at the point where this business in this quarter has actually at the restaurant level generated money.
Revenue growth only tells part of the story. The real test of these businesses is whether their older, same store sales and not their new, less mature stores are actually better. Jubilant's same store numbers this quarter were the best among the three, recording 11.6% growth. Within that, however, their delivery business grew over 20%. Their core business model of getting pizza to your door got even stronger this quarter. Westlife's same store sales barely grew at 0.5%, but it's their third straight quarter moving in the right direction. They launched a Korean themed menu in March, expecting it to meaningfully impact next quarter results. McDonald's affordable McSaver line is saving a major chunk of their dine in. However, even with positive same store growth, each McDonald's location is actually generating less money per year than before, down 3% to about Rs 6.2 crore. Their stores in smaller cities or different formats aren't as profitable as their established big city locations. Moreover, locations in southern states are underperforming more than others.
Is it dragging down the SSG? Absolutely. So while we are doing quite well in West, we're not doing as well in South. We did put few experiments in. Some of them are gaining green shoots, and we need to develop our execution excellence for South specifically, which is what Akshay talked about when he said that we're putting up a team, including a business officer, who will directly work with us to ensure that this execution excellence happens in South.
RPA's same-store performance grew merely 3%. Almost all of that growth came from dine-in rather than delivery. Much like Westlife, they're doubling down on Korean-themed menu items, which are already showing results for them. The real question, however, is how does growth in same-store sales translate to actual profits? Jubilant, like other companies, faced the brutal reality of cost inflation. Raw material costs exploded 28% year over year. Everything from cheese to flour to chicken got significantly more expensive. And instead of passing these costs entirely to customers, they chose to absorb much of the impact. This put pressure on their margins, with their EBITDA margin compressing to 19% from 19.3%. They hope that by not raising prices, they gain more market share. Plus, Jubilant has been cleaning up their portfolio by removing loss-making lines like their Russian operations. Westlife, on the other hand, didn't hurt from cost inflation as much. If anything, they actually made more money while everything around them got more expensive. They managed to cut their food costs from 30% down to about 28% of sales. How? Well, the biggest reason their management states is that their supply chain, including how they procure raw materials for burgers, became more efficient in the long term, but they don't fully elaborate how. The margins were also propped up by a small price raise in March, but the increase wasn't too big to deter repeat orders from customers. Their EBITDA margins remained relatively more stable at 13%.
There was a marginal price increase taken in March, but it was a very marginal price increase. Like Akshay talked about, a lot of them are supply chain efficiencies, commodity efficiencies, which have come in, and then we believe that they are structural in nature, and we should be able to sustain them.
RPA's Indian arm saw their EBITDA margin go up to 4.1% from 3.6%, already a measly range compared to its peers. They added Rs 10 crore in employee expenses during the quarter to train staff to help customers navigate self-ordering systems and manage more complex operations. They also absorbed Rs 7 crore in one-time costs from closing 5 underperforming stores in India, while also investing in new stores, as we mentioned earlier. And they're hoping that these expenses pay off in the future.
There's a lot of stuff that get thrown at the restaurant, and we want to make sure that proper training is going on in the restaurant and so forth. But that line in future, as the top line increases, will go down to between 9.5-10% kind of a range. So that room is available to us. We just don't want to avail it now. We want to avail it in the future. We want to invest right now that 0.5% that we had initially not planned, to make sure that all the initiatives are working well. So all those are the line items where the rooms are there, and the top line is the biggest one, because you take the same rent and have a bigger top line, your margin improve on the same rent. So that's the answer to that.
So here's the bottom line. Success in the restaurant business isn't just about making good food anymore. It's about making tough choices. Where do you open? Where do you shut a loss-making store? Do you expand aggressively or play it safe? Do you invest in fancy technology or focus on getting the basics right? In an industry where one bad restaurant location can drag down results for years and one viral menu item can boost sales for months, these strategic choices will likely determine who comes out ahead as India's food delivery and dining market keeps evolving. Now coming to the tidbits. Just 2 months after India's solar surge pushed power prices near zero, a correction has arrived. The MNRE has confirmed curbs on solar output to stabilize the grid. Rajasthan, the top solar state, saw curtailments as high as 48% during peak hours, erasing nearly $26 million in developer revenue since April, according to NSEFI. Heavyweights like Adani, Tata, and AWS are directly hit. Coming to the next tidbit, OpenAI has rolled out ChatGPT Go, an India-only subscription plan priced at Rs 399 per month, its cheapest offering yet. The move targets India's nearly 1 billion internet users, making advanced AI more accessible in one of its fastest-growing markets. Coming to the next tidbit, Reliance Consumer Products has acquired a majority stake in Nature Edge Beverages, the firm behind the zero-sugar, herb-based Shunya brand. The strategic move strengthens Reliance's health-focused beverage portfolio, already including Campa, Sosio, Spinner, and Ruskik, to tap growing demand for sugar-free drinks. Coming to the next tidbit. India's state-run telecom company, MTNL, has defaulted on loan repayments of Rs 86.6 billion, covering Rs 77.9 billion in principal and Rs 8.65 billion in overdue interest to 7 public sector banks. Total debt has now risen to Rs 345.8 billion, highlighting mounting financial distress in the increasingly uncompetitive telecom firm. That's all the news I have for you today. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.